Software shares lag, apparel stocks shine, and investors left with a short runway to sort it all out. Live from Studio One here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Short runway because, for an hour there, Romaine, we were not getting updates on the S&P index and the Dow. That was kind of fun for the day. Let's try to take a check-in here on where we are. So the idea is we're selling heavy on equities, and it's a buy bonds kind of thing. It's definitely tech that's taken the blame, but it's pretty much across the board. You got tech lower, really look at Salesforce, the S&P, but also commodities lower as well. You get the safety trade coming in to the bond market, Romaine.
Yeah, I want you to take a closer look, too, at the divergence that we're seeing right now between the broader market, particularly the NASDAQ and the Russell 2000. In fact, it's the biggest daily performance gap that we've seen in more than a month. The NASDAQ, of course, dragged down by Salesforce as the ultimate growth stock, telling investors to prepare for what will be the slowest quarterly sales growth in the company's 25-year history. Renewed concern out there that software companies really aren't reaping the full benefit of that AI hype train. Rishi Jaluria over at RBC Capital, he foreshadowed this in the interview yesterday.
Maybe I would question if a lot of the focus of CIOs on AI is coming at the expense of expansions for Salesforce.
Oracle, Intuit, Adobe, and ServiceNow also selling off alongside Salesforce. Meanwhile, the Russell 2000 and the S&P midcaps rallying on the back of encouraging earnings out of the retailers. That includes Burlington, Birkenstock, Foot Locker, and even, Best Buy. Gap, Nordstrom, and Ulta all have the potential to add to the retail optimism when they report after the bell tonight. And while each one of those earnings beats was much more specific to each individual company, idiosyncratic stories, if you will, there is a tie that binds them all together. And unfortunately, that tie is one of inflation risk. Foot Locker CEO Mary Dillon said her consumers are still pressured by inflation, a sentiment echoed by the CEO over at Kohl's, as well as Burlington's chief, who now sees high-income shoppers feeling the pinch. We're going to get a more definitive read on that tomorrow, Alex, with the latest monthly PCE update from the U.S. government, which will show how much inflation is eating into personal income and spending.
And we got a preview of that, Romaine, today when we got the second quarter read of the first quarter GDP, and this came from the personal consumption category. It fell to 2%. The previous reading was 2.5%. So this is a great chart of the last 5 years. You can just see how we're kind of rolling over a bit. However, growth in disposable income was marked up to 1.9%. That may bode well then for spending down the road. But this number right here definitely shows, Romaine, that consumers are tightening their belts, and you know that you can blame inflation.
All right, let's kick things off to the close here on this Thursday afternoon with Kate Moore, head of thematic strategy and global allocation team over at BlackRock. Kate, great to have you here in studio.
Yeah, great to be here, Romaine.
Let's start off, I guess, talking about kind of the health of the consumer, because, I mean, we've gotten all these retail earnings, and we should point out it's a mixed bag. Despite the rally we're getting today, you have some stocks doing great. You have other companies like Kohl's doing poorly. Is there a tie that sort of binds all this together?
It's been really difficult to say there is one specific trend around the consumer. I mean, this is the challenge. You get a cross current every day, and then the market trades on that anecdote or that comment from a management team or, same store sales number, and they try and extrapolate it out to the rest of the entire industry. I think it's really hard to tell. We think the consumer is in okay shape. Not exceptional, but okay shape, and that there's a lot of divergence underneath the surface. We know the low-end consumer has been under more stress. We know consumers are worried about the headlines around inflation, even as their own incomes start to grow. But that kind of perception of persistent inflation may lead to a change in behavior in the back half of this year, and that's what we're watching. Short answer, I don't really know. Yeah. It's all over the place.
Well, I mean, I remember, it was a couple of years ago when we were also having these conversations about the health of the consumer, and instead of sort of the consumer dropping off the map, we just tended to see that consumer spending rotate, right?
Yeah.
From goods to services, maybe back to goods and then back to services again. Is it plausible or possible that we just see a rotation in that spending, or is this finally that cliff where consumers just decide, you know what, I bought enough?
I think there's this big gap between the rhetoric and the action at this point. There's a lot of I feel uncomfortable, and then, perhaps they're going to some stores less than others. But I think the experiential spend is going to be really resilient. And we're going to be watching this throughout the summer as people go to music festivals, as they spend in restaurants, as they travel. Our expectation is, despite the concerns the consumer has and some of the anecdotes coming out of first quarter earnings, the experiential spend is going to look quite good over the next couple months.
So what's positioning like? What do you like? Are you overweight to risk right now? And what does risk mean to Kate?
Yeah, well, Kate likes risk. I think you guys know me well enough to know.
True. You like EM, so I mean, you were an EM person. So
I was an EM
like
person, yeah, and but I love equities still. And I have a friend who sort of dubbed me Miss Bull Market over the last 15 years, but it's not been wrong either. We actually have overweight equity risk in the portfolio, a tiny bit below where we were in kind of the peak in March. And we see actually a lot of opportunities. On these down days, there's some really high quality companies, let's say in the tech space, that are getting a little bit more attractive from a pricing perspective and that we want to own for a multiple year basis. So we're being opportunistic there. I think we're going to have a good, strong end of this year, even if we have some turbulence over the course of the summer. So for those people who are worried about headlines and worried about the election, I would say don't sit this out. In every presidential election year since 1944, the S&P has ended up at the end of the year. And so look through the turbulence, stay focused on the secular stories, stay focused on technology and growth.
So let's go to technology for a second, because technology is what's getting really hit today, in particular the software stocks like a Salesforce. I know you don't do specific names, but is the idea that, or like broad tech, you want to buy on a dip, or are you being super targeted? Because software will eventually benefit, but basically you're seeing the spend just move from like cloud to AI. It's got to swing back.
Well, I would say even within software, there are a bunch of different verticals that are all getting hit in the same way and doesn't make any sense. Even if companies direct more of their spend towards AI, there are parts of the software space, and I would put kind of cyber and security there, that are going to be Teflon areas of spend. No company can afford to have a data breach. No company can afford to have, any information leak out, especially as they use more cloud-based services and especially as AI becomes a bigger part of their process. So, I mean, those stocks have sold off today as well. And yet I still see very strong fundamentals over the medium term there.
Is that going to be broad-based, though? I mean, everyone's sort of looking for who the winners are. And I mean, up until now, it's been a pretty narrow selection process, right? The NVIDIAs and Microsofts of the world. But everyone is sort of looking for a broadening out of that. Is there, when you look at that main theme here with AI and this sort of new inflection in technology right now, is there hope that this broadens out?
Everyone wants it to broaden out because there's a fear that they've missed it if they haven't been in some specific hardware names over the last year and a half, 2 years. I don't think that's a fear people should have. I think there's a lot more upside. One of the things we talk about on the team is that the total addressable market for AI is so much bigger than anyone even thought 3 months ago, 6 months ago, 12 months ago. We probably don't have a great grasp there. But there are additional opportunities, I think, to invest in the theme. And these are kind of cloud-based services, overall AI infrastructure. And of course, like everyone else, we're doing a lot of work on the data centers and power and the resources required to really power up AI.
All right, Kate, going to have to leave it there. Always great to talk to you.
Thank you.
Kate Moore, actually, believe it or not, Kate, I misspoke. You're sticking with us, I'm told.
Okay.
Kate Moore, head of thematic strategy and the global allocation team over at BlackRock. She's going to stick with us. When we come back after the break, we're going to have a deeper conversation with her about what's going on out there. We're also going to take a closer look at those shares of Salesforce, which are plunging today here on the back of that very concerning forecast. Alex.
All right, plus the insurance industry is bracing for a potentially extraordinary hurricane season in the Atlantic. So we're going to talk about that and other challenges facing the industry with Bruce Carnegie-Brown, chairman of Lloyd's of London.
And we're going to get some additional insight on the health of the consumer. G.J. Hart, president and CEO of the restaurant chain Red Robin Gourmet Burgers. He'll be joining us in a second, right here on The Close. This is Bloomberg.
All right, shares of Kohl's plunging the most on record. And here's probably why. The CEO, Tom Kingsbury, saying on the conference call earlier, quote, our customers continue to be pressured by a number of economic factors, including high interest rates and inflation, while spending among our high-income customers has already remained steady. Our middle-income consumer continues to be impacted. I want to bring in Kate Moore, head of thematic strategy and global allocation team over at BlackRock. So if you wanted to bet on the consumer and what they actually are spending on and what they actually like to do, how do you do that in this environment?
Well, I would say two things. We talked a little bit before the break around the experiential spend. That I think is going to stay really resilient. And I think in the consumer, you do want to be a real security selector here. This is like a place to take idiosyncratic risk instead of saying, I'm buying all of discretionary or I'm buying all of staples. There are brands and companies that will be the haves, and they are, continuing to maintain their margins and continuing to maintain a lot of market share, and others that I think are more challenged. Look, we've heard from a lot of these consumer companies. The low-end consumer is cracked a little bit, the middle is okay, right, and the high-end consumer is spending well. So some of the companies that are really skewed towards the high-end consumer, to those kind of upper quintile of household earners, I think we want to be most overweight.
Most overweight, the high quintile earners there. How does that apply then to other sectors that has exposure to that as well? Like autos, I'm thinking about housing, like the ancillary consumer plays.
Yeah, look, here's what I will say. We're not seeing broad-based cracks, and it's one of the reasons why we're constructive on the overall economy. But we are really conscious of the two factors that are affecting consumer sentiment at the moment. Number one is, the pace of disinflation, which has a little bit disappointed so far in the beginning part of 2024. We all wanted to see prices come down further. We're not seeing that happen. And number two is around employment and unemployment. We know that people are well employed at the moment, but whether or not they get significant wage gains, and whether or not they feel those wage gains are enough above and beyond what they're experiencing in their inflationary spend, is what we're really kind of focused on. So the sentiment is TBD.
Yeah. How do you square that, though, with some of the comments that we're getting out of Fed? I thought it was interesting. John Williams was talking a lot about this. And he's basically saying, look, there might be actually room to cut rates at some point this year. We've heard from a couple of the Fed members say that. But then at the same time, they're also talking about real incomes and how that's not necessarily as strong and healthy as they have looked. Now, I know strictly from an inflation perspective, maybe that works in their favor. But when we talk about the health of the economy, that doesn't sound healthy.
Well, look, I think being a Fed decision maker right now is one of the most challenging jobs because there are all these cross currents and all these different pockets that we're talking about. We have not thrown in the towel on the possibility for one rate cut, or perhaps two this year if we resume the disinflationary trend. But the really important thing the Fed has to do is make sure that trend is going to persist into 2025. One rate cut does almost nothing for the low-end consumer that's feeling the pinch. Two won't even do that much. So it has to be something that they can continue over a period of meetings and not just a one or two off. And I think the bar to kind of get to that decision point is extremely high, and we're hearing that from the Fed speakers. But again, we haven't thrown in the towel. We still think it's a possibility that we'll get a cut.
Do you think this year?
Yeah.
Yeah, and is that going to matter? Like, for example, we came into this year and everybody thought we were going to get whatever, the 5, 6, 7 cuts or whatever, and that would have a material impact on things. If we do get to so late in the year where there's really only room for 25 basis points, maybe 50 basis points, is that going to have a material impact?
I don't think it's going to, but sentiment is really important, as I mentioned, as consumers are stressing about like food prices and insurance prices and all of these things that they feel are very sticky and look much higher than they did 3 or 4 years ago. And that's going to be really important to signal from the Fed that there's a disinflationary trend in place, particularly as we go into the election. Look, this is really tricky, but one rate cut doesn't change the spending pattern, but it may change sentiment, and it may increase the willingness to spend in the back half of this year.
Yeah, I mean, just the idea, and you've seen financial conditions loosen, just the idea of it. So, go figure. Kate, listen, it's so great to catch up with you. Thank you so very much for being here. Kate Moore, head of thematic strategy and the global allocation team over at BlackRock. So let's get another read on the consumer from the perspective of food and dining industry. You would think it would be a really tough industry to be in right now, but maybe that's not the case. GJ Hart is president and CEO of Red Robin Gourmet Burgers, and he joins us now. GJ, your actual number is disappointed, but your stock is up today. You've seen some really good growth just in the last couple months. What's driving it when some of the overall data shows a weaker consumer?
Yeah, well, first of all, it's great to be with you all. I would say that given our situation is somewhat different than the backdrop of what's going on in the overall economy, meaning that we've got a comeback situation here where we've developed a strategy called the North Star Plan. So we've improved our hospitality. We've added back great quality food. 85% of the menu has been improved. And we're really focused on going back to bringing this iconic brand relevant and positioned well in casual dining. And so what we're seeing from the consumer at this point, and part of the reason why in the first first quarter may not have been exactly what people expected. What they were really surprised with is our sequential improvement during the quarter. And then, in fact, we reported positive comp store sales in the first 5 weeks of the second quarter. So what we're seeing is real improvement and real growth in terms of lapsed users, new users, et cetera. And, overall from the consumers, we're seeing our high-end premium burgers still do extremely well. Our lower tavern line of burgers, which we do see some trade down into that, but that's okay. And our overall add-ons, desserts, appetizers, et cetera, are holding steady. So at the end of the day, we're seeing a pretty resilient consumer. And, what we like to see in us with our comeback plan is that we're seeing real growth here. So we're pretty optimistic.
When we talk about sort of the growth going forward, GJ, particularly if we are in a period where we are seeing consumers be a little choosier, if you will, here, who are you looking to in terms of your competitors that you, I guess, need to be most concerned about, or at least the ones where you feel like, okay, this could potentially be where those customers go. Let's find a way to keep them in the doors of Red Robin.
Yeah. So, look, I would say that any of the casual diners from Chili's, Applebee's, Texas Roadhouse, clearly we pay attention to. But given where we are in our journey, I liken it this way. If you're running a 100-yard dash and you look over your shoulder, you're going to lose the race. And so for us, it's first things first. Let's make sure that we come back to what this iconic brand stands for, being relevant and creating that fun environment, great food, great hospitality at a reasonable price, everyday value, and focus on really executing that at a high level. And if we do that, clearly we need to pay attention to what others are doing, but we're going to get our disproportionate share.
How are your costs and how are you managing them in terms of food and input and also labor?
Sure. Well, from an overall commodity perspective and inflation in overall the basket, we've reaffirmed sort of 3 to 5%. And while we'd like to see it a little bit lower, it's not as bad as it's been in the previous years. So we've planned for that. From a labor perspective, it's certainly challenging. You see some of the actions taken by states and some of the mandates that are coming through, and there's always pressure on labor. But in our case, our strategy is bring back hospitality and put the appropriate amount of staffing in the restaurants and stay the course to earn the right for guests to come back and enjoy Red Robin. And so that's some of the investment we put into the first quarter. We put it into 2023, and we'll continue to do so because we believe in the long game here that overall that will continue to drive traffic, and that's the name of the game. So
GJ, I mean, what type of customers though are now sort of making up the bulk of what you get? Are you seeing like sort of big groups of families, or is this more individuals and couples coming in? Give me a sense of the complexion.
Sure. Well, look, we're a family-friendly restaurant where you can have a lot of fun and bring your kids. But at the same time, we're an environment where it's okay to come to us for a date night or an evening out or a business meal. And so we're seeing a pretty broad spectrum of folks coming to dine with us. But again, in our case, given where we are in our journey, we're seeing a lot of lapsed users come back because we're telling them, hey, we've improved 85% of our menu. We've brought hospitality back. We're creating more fun. And so come give us a try. So we're seeing lapsed users. We're seeing new users at levels that we haven't seen for a while. We see that in our launch of our loyalty platform, and the numbers that we're seeing are, some of the highest numbers in terms of new members. So lots of good improvement, but generally speaking, that's our consumer base.
All right, GJ, really appreciate you taking time for us. GJ Hart there, President and CEO of Red Robin Gourmet Burgers. When we come back after the break, a closer look at the big downdraft that we're seeing right now in the software stock. Salesforce, the biggest decliner in the S&P, the biggest decliner in the Russell 1000. That's UiPath, a 34% drop in those shares on the back of a bad earnings report and the ouster of its CEO. That's coming up next. This is The Close.
We have some breaking news for you. Apparently, the U.S. is reining in AI chip sales to the Middle East by NVIDIA and AMD. The U.S. is worried about the technology getting diverted to China, and they're worried about that large-scale AI accelerator shipments to the Middle East and then eventually going to China. It's unclear how long this review will take. There is also not a concrete definition of what constitutes a large shipment, so there are much more questions than answers, but the stocks are moving on that. NVIDIA stock is down about 2.5%, right around those session lows. Romain?
All right, one of the big movers out there. Let's take a look at some of the other movers here. Our top calls, the big movers on the back of analyst recommendations. And we start off with Corning here. An interesting move to up overweight over at JP Morgan, which says cyclical and secular tailwinds lining up favorably for the communications equipment company. The analyst says that should position Corning to leverage that upcycle in revenue by as much as 7% through 2026. Shares up by 3.5%. Next, let's go to life sciences equipment maker Agilent, getting cut to sell over at CFRA after the company slashed its profit and sales outlook. While the analyst expects a better second half, he's still skeptical about Agilent due to continued weakness in its business in China. Those shares having an awful day, down about 8.5%. And let's end on UiPath, the disappointing annual forecast and the surprise departure of its CEO, spurring a number of downgrades, including a cut to sector weight over at KeyBanc. Analyst Jason Celino citing near-term growth challenges for the company, as well as heightened execution risk. He scraps that $27 price target altogether, and investors appear to be scrapping the stock altogether. The shares having their worst day since they went public all the way back in 2021. Those are some of our top calls, but we do want to stick on UiPath here with Jason Celino, equity research analyst over at KeyBanc. And Jason, let's focus in on the CEO change, because that really seemed to rattle a lot of folks here. This was a CEO that was brought in with a lot of fanfare before this company went public, a great pedigree from SAP, a great pedigree from Google, and now he's out the door. Any sense of why?
Yeah, thanks, Romain. Thanks for having us. Definitely a surprise to us. Our prior thesis was predicated on some of the improvements that he was planning to make. It'd only been 3 months since he was promoted to sole CEO. The company says he's leaving for personal reasons, and the co-founder, Daniel Dines, who will be returning as CEO, maintains a good relationship with him. But definitely a surprise to us.
Does this all just point to the fact that part of that is obviously a UiPath issue, right? But overall, you're looking at the software industry really struggling because you have companies that are diverting money from data centers and software to basically AI. Where are we in that cycle?
Yeah, no, that's a fair question for sure. I think in an environment like this, where it's a little tougher to close deals and sales cycles might lengthen, when you are making go-to-market changes, it can exacerbate some of the macro issues as well.
All right, hey, Jason, thanks for jumping on with us. Really appreciate it. Jason Celino over at KeyBanc Capital Markets. It just depends on when we get that trough, right? It's going to be really hard for these stocks to find their footing when you have all the money just going to AI, unless you can offer both.
Yeah, and that was the big question here. I mean, when we saw Salesforce's earnings, I think everybody was so rattled by the slowdown in growth, but they're also rattled by the idea of what is the AI narrative. Salesforce is the behemoth. They'll have an AI narrative.
Yep.
But what about these other second-tier companies? No disrespect to UiPath, but if they don't have that narrative here, investors aren't going to sit around and wait for it.
But even in Salesforce, it's a division that has AI, even though it's relatively small, but still growing 25%, and it still got really hammered. So what do you do if you're UiPath or Workday, for example?
Well, they could start by getting the new CEO and having some guidance here going forward for those investors out there. All right, a lot more coming up here on The Close. Stick with us. We'll be back in a moment. This is Bloomberg. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostick.
And I'm Alex Steele. Let's get back to this news that just broke, Romain, is that the U.S. is apparently reining in AI chips that are being sold to the Middle East by NVIDIA and AMD. They're worried that that could be a gateway then to China.
Yeah, I mean, I was surprised by this and also not surprised. I mean, given, of course, how the approach they've taken with China, it sort of made sense that at some point they would look to other regions to make sure that there isn't sort of these loopholes. I am curious as to how exactly they're going to pull this off.
Yeah, and I was looking at NVIDIA and I was like, wait, do they sell a lot of chips to the Middle East? But then the direction to China made a lot of sense. And then you have to flip it too. Like, what about stuff coming in from Mexico and Canada that leaves China first and then comes through if you're doing it the opposite direction? How do you monitor and track all of that?
Yeah, and it's kind of interesting, too. There was a big story just yesterday involving Lam Research and some of the sort of workarounds that some of the secondary companies had used to get their hands on some of their technology and get it over there into Asia. So obviously something that's very complicated and it's not going to be an easy fix.
No, and NVIDIA stock is down over 2.5%, so right around session lows. Also, do you know what Saturday is?
No.
Okay, it's June 1st.
Okay.
It is the start of hurricane season.
Okay.
And this is a humongous deal because the storms that we're seeing here in the U.S. are just becoming worse and worse. And this year's hurricane season could actually be, quote, extraordinary. They're forecasting 17 to 25 storms could become named tropical cyclones. 8 to 13 could develop into hurricanes, which means winds of at least 74 miles an hour. And 4 to 7 of those could turn into major hurricanes with winds of at least 111 miles per hour. And that starts June 1st. One of the many challenges facing the insurance sector, then you add on AI and cybersecurity, and it gets really tough. Well, Bruce Carnegie-Brown is chairman of Lloyd's of London, and he joins us here on set. Bruce, you have a really big business in the U.S. too. I know you're Lloyd's of London, but you're also like Lloyd's of London in the U.S., right? I mean,
so 50% of our business comes from the U.S.
So how do you manage climate change? What do you do when the storms are unpredictable, they come at different times, and they are catastrophic?
Well, so as a basic premise, insurance has a chance to reprice and restructure annually because people buy one-year policies. And we take in a new set of data each year and we add it to a long data set. And so if risks are linear, it's reasonably easy for us to adjust our models and continue to provide the insurance. If something exponential is happening, then the risk is that we're behind the curve all of the time. And that is potentially what is happening with climate change. So 25% of our capital is tied up in supporting natural catastrophe risks around the world, a big part of that in the United States, where the values are clearly very high. And so we worry a lot about these issues because it's not just a question of whether insurance is available. It's got to be affordable. Otherwise, people don't buy it. So there needs to be a partnership between government essentially and regulators to make sure there's enough resilience in the economy that the losses we're protecting against are unexpected, because the model breaks down if the loss is expected.
But I am curious, I mean, when you talk to your members, I mean, we've already seen insurance companies themselves pull back in certain markets. We've seen the reinsurers pull back. I mean, to a certain degree, there are certain parts of this country now that are completely dependent on the government and regulators to either provide their insurance or at least to subsidize it pretty heavily here. Is that actually something that works in your business model, or is that something that's going to be completely separate?
No, well, governments, we do need to partner with governments in many cases, particularly around systemic kinds of risks, which I think climate would be one, cyber would be another. The risks are just too big for the insurance industry alone to support. But the real issue we need is behavioral change. You know, people need to build in different places. They need to build with greater resiliency. Most building regulations are pretty tough in the United States, particularly in hurricane-affected areas, for instance, or natural catastrophe-affected areas. But what's happening is places that didn't used to be natural catastrophe-affected areas are now experiencing these things. Germany is quite a good example of this. Nobody thought of Germany as a natural catastrophe environment, but they now regularly have extraordinary flooding and hailstorms through a given season.
I am curious, I mean, outside of weather and climate change issues, there are a lot of other issues swirling around here. I think we were just talking during the commercial break here about the advent of AI, some of these new technologies here. This in and of itself has become an insurance risk.
Yes, so we're on both sides of the ledger. We can use AI to be smarter about the risks that we underwrite, but equally AI is going to be used by bad actors to break down security defenses of our customers, and that will result in greater claims. And so we need to begin to understand this and how we can support our customers going through that. But interestingly, so the first ever cyber insurance policy was underwritten at Lloyd's in 1999. So the industry for insurance is only 25 years old. And in the beginning, people described it as a bit like a homeowner's policy where you could leave the front door open and you still had to pay the claim. And a bit like you wouldn't expect to get homeowners cover today if you don't have a burglar alarm or mortise locks on your windows. So we're beginning to have conversations with our customers about how they mitigate against these cyber threats. And of course, the value of doing that is to build resilience in the overall economy against the risk of cyber attack.
What's your relationship like with your reinsurers to then help your customers in terms of these threats?
Well, so, we lay off some of our risk, which is where the reinsurance comes in. We actually do reinsurance ourselves for other insurance companies too. So this is about sharing risk in order to be able to provide meaningful amounts of cover when a disaster happens.
Where in that process do you feel is the biggest gap between the pricing that you need to mitigate your risk versus the pricing that customers whether it be homeowners or a company, can afford to pay? Where's that gap the largest?
Well, it develops in different ways around different risks. So, I was challenged yesterday by somebody who said their homeowners policy had gone up 40%. And why was that? And, it's four things, or three things really, that are key there. The first is the value of their property has gone up, so the cover is greater. The second thing is with persistent inflation, we've had replacement costs going up, both materials and building contractors. And then, of course, the overlay of natural catastrophe risk has increased as well. Now, if it goes up too high, of course, the owner stops buying the cover. That's not good for us, and it's definitely not good for them.
When you look at some of the bigger sort of structural changes out there, the ones that will have an impact either on your members' businesses or just really the insurance industry writ large here, what is most important to you right now, most important to watch?
Well, we've got to respond to changing risks that our customers face. So one of the things, if you've been insuring bricks and mortar for 200 years, you've got to wake up and recognize that in an enterprise value of most of the businesses we look after, bricks and mortar are a smaller and smaller part of it. And they're increasingly valued on intangible risks. And so, we now develop products to support outages on platforms in the cloud, because these are bigger risks for many companies than whether their inventory burns or their buildings are knocked down. So what we've got to do is innovate around the changing risk landscape.
All right. Well, fascinating stuff here. I really appreciate you stopping by today. Bruce Carnegie-Brown there, chairman of Lloyd's of London. Now, we do want to go back, of course, to that breaking news from a little while ago. This involving chip makers. NVIDIA shares down about 3% right now on the back of a report that the U.S. is now looking to rein in chip sales to the Middle East, primarily as a way to prevent some of those advanced technologies getting into the hands of China, Alex.
Yeah, you got NVIDIA down 2.8%. It's so interesting, and I wonder how you follow it, how you deal with it, and how you go up the supply chain with that. We're going to tackle that in just a moment. This is Bloomberg.
All right, welcome back. Some breaking news. U.S. officials pulling back on issuing licenses to chip makers, including NVIDIA and AMD, to sell to folks in the Middle East. This is according to officials familiar with the matter that spoke on condition of anonymity. A national security review of chips linked to AI development now underway. Kailey Leinz joining us right now, the co-host of Bloomberg's Balance of Power. Kailey, this kind of came out of the blue, or did it? I mean, what more do we know about this?
Well, we know that the Biden administration is very focused on artificial intelligence and the chips that power them, and the concern that they want to make sure that it doesn't get into the hands of adversaries like China, which is why we have seen put in place a number of export restrictions specifically as to what could go to China. But also back in October, I would remind everyone, the Commerce Department did put export restrictions on chips to the Middle East as well. So to a certain extent, concern around this region is not new. What this news is, though, is essentially that within the last several weeks, according to our reporting, officials have delayed or not responded to license applications submitted by companies like NVIDIA and AMD in the last several weeks, specifically for large-scale AI accelerator shipments. That essentially, the AI accelerators are the things you need if you want to build out an AI infrastructure, because they help power the data centers that are trying to essentially make sense of all this information and develop the actual chatbots and the like. The concern here really seems to be on these national security grounds, and why they are conducting this review is the way in which sending large-scale shipments to the Middle East, though it's not exactly clear what large-scale is defined as here, could be a way for China to get around the restrictions that the U.S. has put into place and access these chips and data centers to develop their own technology. And that technology getting into the hands of, say, the Chinese military is what the U.S. is really looking to avoid, which is why we are potentially seeing here an expansion of these restrictions that these companies are going to have to be contending with.
Kailey, how far along are these discussions, and how do they expect to track all of this?
It's really complicated, Alex, as far as how far into these discussions we actually are. We know the review is underway. What is unclear is just how long this review might take. That timeline right now is not known, but obviously, as we have gotten reporting from these sources, that this has been something happening over the course of the last several weeks, that we have started to see a change in behavior and actually granting of these licenses and issuing them, that this is active and underway as we speak. As for the tracking all of this, this is where this gets incredibly complicated, not just for the government if you were trying to administer these regulations and make sure no one is in violation of them, but of course for the companies. We have seen NVIDIA already dealing with this in terms of what chips can and cannot be sent to China. There has been a lot of talk about the workarounds or the way in which they could develop some chips that are less advanced in terms of the actual nanometers than others and making made for China type chips. This gets very complicated, and a lot of companies are kind of caught in the middle of it.
I want to pivot, Kailey, to another story that also just broke, and this has to do with the never-ending saga involving TikTok. This time, Snap getting dragged into it, and the headline is basically that TikTok is preparing a U.S. copy of the app's core algorithm. What is this about?
Yeah, this is reporting from Reuters, and I would just remind our audience, Romaine, that the U.S. has passed legislation. It's been signed into law by President Biden that within the course of a year, less now, TikTok would need to divest, or ByteDance specifically, its Chinese over, would need to divest the U.S. arm of TikTok or risk being banned in the United States. There has been a lot of question around that potential divestiture, which TikTok and ByteDance do not want to do. They've, in fact, sued the U.S. government over this issue earlier this month. The question of what would happen to the algorithm, even if the company were to spin off TikTok US. What Reuters is reporting is that they are working on a clone of that recommendation algorithm that could result in a version that operates independently of its Chinese parent. So essentially, this may be a way to try to satisfy lawmakers who are also very concerned about the national security implications of this platform and the way in which data could be shared with the Chinese Communist Party, that if this algorithm were operating independently in the U.S., maybe it is a workaround of those concerns. But of course, there already is law out there, and that's what is a complicating factor.
Kailey, we really appreciate it. Thanks for jumping on at Bloomberg's Kailey Leinz joining us there. Should point out tech around the lows of the session, the NASDAQ down by a full percentage point. Coming up, we're going to count you down to the closing bells. Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab, will be joining us. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostic alongside Alex Steele. With about 10 minutes until we get to those closing bells here, and stocks right now at session lows. Of course, the biggest drag right now in the tech space, with the NASDAQ down more than 1%.
Yep, and you can really blame NVIDIA for that. It was already the worst performer, with Salesforce also down by over 20%. But now NVIDIA catching a bit to the downside, also down over 4%. So really picking up that steam. The Russell 2000, though, outperforming all across the board. Yes, off the highs. Yes, rolling over as NVIDIA rolls over, but nonetheless eking out that gain of 0.7%. That's not a world where the consumer is doing poorly if the Russell 2000 is up and outperforming.
Yeah, giving back some of the gains, more than half the gains here on the day. But I guess you did have some encouraging spots out of some of the retail earnings that we got over the last 24 hours. Maybe, just maybe, that'll be ratified when we get that personal income and spending data and inflation data tomorrow. We had a chance to catch up with Kate Moore a little bit earlier. She's actually staying positive on stocks. Here's why.
I think we're going to have a good, strong end of this year, even if we have some turbulence over the course of the summer. So for those people who are worried about headlines and worried about the election, I would say don't sit this out. You know, in every presidential election year since 1944, the S&P has ended up at the end of the year.
And that was Kate Moore over at BlackRock, who helped kick us off to the close just about an hour ago. And now, to take us to those closing bells, Jeff Kleintop, Chief Global Investment Strategist over at Charles Schwab. All right, Jeff, I mean, this is a market that's been, I guess, in a little bit of a stasis since hitting those record highs. And I think everyone's sort of wondering when that reset comes for the next leg of this bull market. Are you as constructive, are you as positive as Kate Moore is right now on the rest of the year?
You know, I'm real positive on the rest of the year for European stocks. This is not an area that a lot of investors have been focused on, but you've got improving economic momentum, a manufacturing recovery that favors them, and reasonable valuations. And now you've actually got earnings growth in the second half of the year likely to outpace that of the U.S. And I'd add a kicker to that, and that's the euro maybe showing some signs of strength. Actually, this month is the first month we've seen the euro up versus the dollar. Might be more of that to come.
for U.S. investors who maybe believe in what you're saying there, Jeff, and you're not the first to sort of make that pitch here, do you do that by investing directly in European companies, or do you look for U.S.-based companies that maybe have large European exposure?
I think you actually want those European companies themselves. One of the big differences in the relative performance of these global companies that truly have sales all over the map, wherever they're headquartered, is that the investor base is quite different. 80% of the investors in European equities are based in Europe. 80% of the investors in U.S. equities are based here in the U.S., and their outlooks are very different, and their optimism is very different. And valuations in the U.S. reflect that, and the more pessimistic valuations in Europe reflect that. So I actually want to invest in those equities traded overseas because their valuations are low, and there's a lot of pessimism because of the war, because of the recession last year. All that's turning around. So I think you get the PE boost to investing directly in those European equities.
Jeff, I love that you're like, we're 7 minutes into the close in U.S. trading, and you're like, go European equities. But I have heard this argument for years, and it has yet to really pan out.
So here's why it's different this time. Careful when anyone says that, right? Actually, since the bull market began, the one we're currently in, where stocks ended their bear market back in October of 2022, European stocks are actually leading U.S. stocks. They're ahead by 20 percentage points. I think few people recognize this, but the MSCI EMU index, that's the Eurozone index, is outperforming the U.S. even on a dollar basis by 20 percentage points. So many investors are missing that, focusing on NVIDIA and so many other high flyers in the MAG 7 and, well, maybe now the MAG 1. I don't know. But that, I think, is distracting them from this actual underlying performance we're seeing outside the U.S. that's now stretched to a year and a half.
So how much of it, though, also has to do with the central bank most likely cutting next week? Like, does that feed into this process for you at all? Because we don't know what's going to happen after that. Whereas with the Fed, we don't know when they'll cut, but when they do, we can expect an actual cutting cycle.
Yeah, Alex, you're right. It's still a bit of a mystery what happens after the June rate cut from the ECB, but markets are beginning to price in a series of rate cuts. One of the things that's standing out, and you mentioned the Russell 2000 performing well today, but we've seen small cap stocks in Europe outperform all quarter. In fact, they're outperforming large caps by 3 or 4 percentage points, really beginning to price in easier financial conditions in the second half of this year on a series of rate cuts, not just a one and done from the ECB.
All right, Jeff, I'm going to steer you one way or another back here to the U.S. here. Is there anything you like here in the U.S. equity market?
Yeah, I mean, I think financials look pretty good here. It's our favorite sector, and you're seeing this outlook for still a resilient consumer, a relatively resilient labor market. That means that credit losses are not going to be that significant. I think as we see the yield curve get more normally shaped, I think that's all good news for the banking sector. And if you take a look at capital market activity, that's improving as well. IPOs and M&A activity, I think all of that spells good news for the financial sector. One, I think also investors have been overlooking for the last year or so, really just focused on tech.
All right, so if this gets to a point here, Jeff, where we do start to see, and again, coming back here into the U.S., where we do start to see maybe a little bit more of an embrace of things outside of just tech here, I am curious about the cyclical case here, the small cap case, and we've seen that kind of fits and starts over the last, 8 or 9 months, where people have tried to sort of bid up these stocks, and then you get some economic data point, or the Fed spooks them or something. Is there any sort of, argument to be made that we can see a little bit more resiliency in some of those names?
I think it depends on interest rates. They are very rate sensitive. They borrow simply much more than large cap stocks. Large cap stocks actually make money on interest rates because they have so much cash. Generally, smaller caps are borrowers. So we need to see rates begin to come down. We've been in a high rate environment, particularly for five years plus for a while now. As that maybe begins to come down late this year and into next year, that's the environment we need to really see small caps begin to perform well, as they are just so rate sensitive. I think you combine that with the backdrop of an improving economic picture outside the U.S. Remember, we were in a recession last year in Europe and the UK and a number of other places. That's now improving. So the cyclical upswing in earnings combined with easier financial conditions makes that case for both international stocks and small caps.
All right, Jeff, always love talking to you here. Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab, helping us count down to those closing bells. We still got a little ways till we get there, Alex, just about 3 minutes or so here. Stocks on the back foot here, but this has really kind of been a tale of two cities today, right? We talk about the big downdraft that we saw in software stocks, and then the big uptick that we saw in a lot of those retail stocks, which was kind of surprising to me, particularly given that some of those retailers, like Best Buy, did I miss something?
Yeah, and also the inability for Kohl's to also perform too. When they were supposed to be doing relatively well. They have Sephora, their Amazon return packages. They have some designers like Tommy Hilfiger, for example, and that was very much a surprise.
But that gets to a question too. Are they too sort of disparate? I mean, we talk about which retailers are doing well. Some of them are more single brand type retailers that we've talked a lot about. So I don't know if maybe that's also in the mix, and maybe we learn a little bit more out of that tonight. We do get one of the big department stores in Nordstrom.
Yep, Nordstrom, more high end though for sure, but then Gap. But also I was talking to Mary Ross Gilbert of Bloomberg Intelligence. Tough comps for Ross, but for Kohl's, but they are executing, and their plan is working. It's just not working to the fullest extent per se in a tough environment.
We're also going to get Ulta Beauty, so a read on what is it? Invest, right? Splash your face. What did you call it?
Invest in
your face there.
Splash
and Costco as well. Gold bar is apparently going to lift that stock potentially as we move closer to those bells. Stick with us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic as we welcome our audiences across all of our Bloomberg platforms. That includes television, radio, and our partnership with YouTube here on a day where we're seeing most stocks here on the back foot, though some resiliency when it comes to retailers.
Yeah, absolutely, right? We've been certainly focusing on, and actually there are going to be a bunch of my gainers, and we'll get to them in just a moment. We've been thinking, though, I'm sure you guys too, just looking at NVIDIA shares down about 3.6%. Again, a story, a Bloomberg exclusive about U.S. reining in AI chip sales to the Middle East by NVIDIA and AMD. AMD actually higher, but NVIDIA, it's just a reminder that geopolitics, again, can get in the way of companies who are trying to do business.
So you're watching the hardware companies. I'm watching the software companies in the S&P 500, and they are just getting crushed today after kind of in sympathy with Salesforce because of the company projecting the lowest quarterly sales growth in history. A little preview of one of my decliners, but that affecting, Alex, other members of the software industry.
Oh, deep tease, deep tease. I just want to point out, too, though, that I know we can point to Salesforce and we can point to NVIDIA and tech trading heavy, but the whole commodity complex was also taken down as well. As I wonder if we're just in a more of a broader risk-off move today, particularly if you look at that bid in the bond market.
You are seeing a bid, though, come into cryptocurrencies here on this day. The VIX slightly lower on the day, back down around that 14 level here. And then when we talk about the cross-asset space here, yields, maybe that's providing a little bit of tailwind for some stocks here, but we're still going to get some red across the screen for all of the major indices, sans some of the small cap and mid cap names. The Dow Jones Industrial Average lower by more than 300 points on the day, roughly about a drop of 0.9%. The S&P down about 30 points or so, down about 0.6%, while the NASDAQ Composite as well as the NASDAQ 100 each down by about 1.1% here on the day. But if you are looking for green on your screen, you will find it in that small cap, mid cap, and cyclical space. Dow Transport's up 1.3%, S&P 400 mid caps up 1%, and the Russell 2000 up 20 points or 1% on the day.
Yeah, interesting, too, to see the Russell 2000 small caps actually outperforming the other major indices, if you will, up about 1%. Having said that, though, Alex, if you go to the S&P 500, you've got most names in the index actually showing that they are higher for the day, 362 to the upside, 140 to the downside, 1 unchanged.
Yeah, taking a look at IMAP here, super interesting what we're looking at. We're looking at communication services and information technology. Both of those are the two sectors in the red, particularly tech off over 2%. But that's really the Mag 7 and a Salesforce effect. On the upside, you have real estate. Okay, as yields come down, you're going to have real estate do well, and utility is the same deal. But then materials, industrials, and financials also doing relatively well, which is impressive considering that overall commodity sector is selling off.
All right, guys, let's get to some of the individual gainers, if I may. HPQ, Hewlett-Packard, HP, up about 17% in today's session. It's your number one gainer in the S&P 500 today, moving the most intraday ever, highest level in about 2 years after net 2Q revenue from the company beat the average analyst estimate. This resulted in a bunch of analysts on the street, Citi and Morgan, sparking price target hikes by them, and they pointed to HP's robust PC segment. So essentially, they just raised their price target on the company. Hey, Best Buy, Romaine, you mentioned the retailers, some outperformance there. Best Buy up about 13% in today's session. The company's CEO saying during the retailer's earnings call that same-store sales sales for May expected to be better than its guidance for the fiscal second quarter. And then for the first quarter, it reported better than expected profitability, even as sales woes deepened and consumers remained on the sidelines with some of their electronic purchases. But nonetheless, upbeat outlook, and Best Buy up about 13%. Your number 2 gainer in the S&P 500. Foot Locker, another retailer, up about.
When was the last time that happened?
Which part?
The number 2 gainer in the S&P.
I know, it's like unusual names. As you said, retail really dominating. Foot Locker, again, 15% to the upside, up 31% at its highs today. This as the company reported first quarter adjusted earnings per share beat the average analyst estimate. Comp sales seen as better than investors feared. And I got to do one more. Birkenstock up almost 12% in today's session. Its full year revenue forecast topping expectations. So, yeah.
Do you wear Birkenstocks? Because Carol has very fancy shoes, so this is a good indicator for me.
I do not.
I knew it. I knew she didn't. Okay, this means something to me. Anyway.
I love you.
All right, hard pivot from Birkenstock to the cloud. Let's talk about Salesforce, because this was the big one to watch.
A lot of people at Salesforce wear Birkenstocks.
Maybe. Let's talk a little bit about.
What does that even mean?
I don't know. All right. Tech people.
Down 20% today. No laughing matter, as it slid by the most in close to 2 decades. You got to go all the way back to July of 2004 to find a day where we saw Salesforce fall this much in a single day. It projected the slowest quarterly sales growth in its history. It renewed concerns that the company will be left behind in the AI boom. We spoke to Bloomberg Intelligence's Anurag Rana a little earlier in our program about this decline. And what he basically said is that you have a lot of companies shifting their budgets, shifting their tech budgets. Instead of buying software and services right now, they're taking that money and they're buying chips and servers. So think NVIDIA and Dell being the beneficiaries rather than Salesforce and perhaps a company like ServiceNow, which brings me to my next decliner. ServiceNow falling in sympathy with what happened with Salesforce today. Shares of ServiceNow falling by 12%. This after Salesforce gave that weak outlook, and we saw the entire sector just move lower. Also, Kohl's down 23%. The company had its worst day in its history as a publicly traded company. You got to go back to 1992 when that company went public. This after it slashed its guidance for the full year. It reported first quarter results that missed on pretty much every metric. Comp sales for the quarter fell 4.4%. It was the 9th consecutive decline. Analysts had expected only a 1.7% drop. Kohl's offered deep discounts in the period. The company did say, though, that sales of clearance items actually declined, leading to a miss on those comp sales.
Well, where you're seeing the safety big guys today is definitely within the bond market. Not the dollar, but the bond market. You have yields moving lower pretty much across the curve. A nice bid into the belly in particular. Yes, you had that second read first quarter GDP. Man, that's hard. That came in a little lighter. You also had personal consumption a little lighter than expected, but still pretty solid growth. And guys, this is all, of course, ahead of that PCE data tomorrow that I really hope will finally be a catalyst or at least directional for this market.
Yeah, maybe give us a little bit more insights here into what's going on with the Fed. Meanwhile, we continue to get earnings, awaiting quite a few crossing the wire. NetApp already out. Those shares up 3%, and now we're getting Dell crossing the wire right now. And, well, the numbers, they look good. The company, I'm going to start here with the forecast going forward. The company is saying that for the first quarter, this is for the first quarter, the numbers just passed. Net revenue coming in at $9.23 billion. The street was looking for roughly about $9.06 billion. Adjusted EPS also slightly beating at 1.27. The street was looking for $1.23 here. Total net revenue coming in $22.24 billion. The street was looking for 21.6 here. So overall, it looks like a beat on all the key metrics here. But as you can see, the share reaction to the downside down 10%.
Yeah, that's pretty significant. Keep in mind that this one has been on such a tremendous run, up 123% year to date. So it does look like there's some disappointment. The Infrastructure Solutions Group, $9.23 billion. You mentioned that. That's up 22% year over year, beating the estimate. Servers, obviously a big thing. We've heard a lot of conversations, if you will, from Dell about the build of AI, the build out and how companies are doing it, not up in the cloud, but they're going to want to be doing it on premise is what they call it. Servers and networking, $5.47 billion, folks. That's a beat. Storage revenue, that's a little light, $376 billion versus the estimate of $3.98 billion. And adjusted EPS, $1.27 versus $1.31 year over year. The estimate was $1.123. So beat, but down from the year before. Stock down 9%. So we're going to have to dig through a little bit to get some of the commentary to find out why there's some disappointment here.
Look, total net revenue also coming in above estimates at $22.24 billion, beating estimates of 21.62. The Client Solutions Group came in above estimates at 11.97 billion. Commercial revenue at 10.15 above estimates. Consumer revenue did come in a little light, but that's a small portion of the company's revenue these days at 1.81 billion versus estimates of $2.06 billion. Alex.
Yeah, just looking at some of the commentary, you had the chief financial officer in the press release talking about how they're really well positioned to take on AI growth, saying that revenue is up 6% in the servers and networking revenue up 42%. They have strong cash flow. They can execute. So clearly, there must be a large expectation game here playing into that decline from Dell down about 9%. But again, as Carol mentioned, it had just skyrocketed after last quarter as everyone kind of remembered that they were an AI play.
Yeah, and there was some easing of some of the GPUs coming from NVIDIA in terms of the AI build-out. So it looks like they are being able to sell servers. Real quickly, Nordstrom folks, if I just want to bring it up, they are first quarter total revenue. It's a slight beat. First quarter adjusted loss per share, 24 cents versus an estimated loss of 7.2 cents. Just a quick check on the stock, and it's down about 2.7% in the aftermarket. A lot of this one is shorted, so we'll continue to track that. All right, guys, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, Beyond the Bell. We will see you again, same time, same place, tomorrow.
All right, don't go anywhere. A slew of earnings out there right now and a slew of big movers really moving here in after hours trading. We'll get to them when we come back after the break, right here on The Close on Bloomberg. Welcome back to The Close. Romaine Bostick here, joined right now by Gina Martin-Adams, the Chief Equity Strategist at Bloomberg Intelligence here, Beyond the Bell.
Thanks, Romaine. It's been a really interesting day in markets. If we look at what happened in cross assets, obviously the S&P 500 struggled, but some really mixed results inside the equity market. The NASDAQ certainly leading declines, while many of the rest of the sectors and small caps even higher on the day. So some mixed results for equities. 10-year rallying on a slightly weaker than expected GDP report, and then the dollar down a little bit of an edge. So really the equities, the bulk of the excitement on this day, where we have plenty of earnings to chew on over the course of the next few minutes.
And it was interesting, too. We started off the day with a big drag from Salesforce earlier here in the day, a drop of 20% here in the cash session, one of the worst days on record. And that really dragged down everything in the software space. Even Microsoft got hit, down 3% here on the day. And UiPath, a bit of an idiosyncratic story with the loss of their CEO, a 34% drop, worst ever for that company in its short history as a public company. Meanwhile, there was a lot of talk today about what was going on in the retail space, and Kohl's really representative of the downside of that, down about 23%, though we should point out some of the other peers in that space actually had pretty good days. But you go back to what's been happening in the technology space, and that is our top story here. And that top story is about the return of PC demand. We saw this yesterday with HP Inc. rising as a lot of folks now apparently are talking about a new cycle in the PC demand era, and not on the consumer side. A lot of this will be with companies refreshing their upcycle here, and apparently Dell also benefiting from that. We saw that in the numbers just released after just a few minutes ago here. Despite the fact that those shares are down here on the day, the company is giving a little bit of hope here that the resurgence in the PC space and in the service space might actually benefit Dell as well. Gina?
Let's get more insight on the latest results from Dell. Joining us now is Jin Ho, Bloomberg Intelligence Senior Analyst. Jin, tell us, what's your first reaction on this release today?
Hey, Gina, how are you? So, look, I think expectations heading into the print were pretty high, largely because of the AI server expectations. Looks like the stock is pulling back off of the results. I would wait for guidance before I make an official comment on where I think the business is going forward.
Well, can you give us, Jin, sort of your general guidance here? Because when we were talking a little while ago, it was all this idea here that, okay, there is an AI story here, a legitimate one, and this is going to have some sort of material benefit, maybe long term. Is there a reason why that didn't show up in this earnings report, and do you expect it could potentially show up in subsequent earnings reports?
Yeah, so it could be a partially timing issue. as well in terms of when the deal closes. I will tell you the server and networking business actually beat by about 10%, beat consensus by about 10%. Now, there is a fairly large Tesla deal that's out there right now, and that's supposed to run the course of the year. So that may be reflected in the guidance, which they only give on the call.
Speaking of guidance, talk to us about the outlook that currently is embedded in the market or in Dell's recent guidance. What is in the outlook that you think is most vulnerable or even presents a greater opportunity for some upside?
Sure. So everyone has their focus on the server and networking guidance right now. In terms of the ISG group, the Infrastructure Solutions Group, they guided to mid-teens growth last quarter for the year. Embedded in that is 25% server and networking growth for people to feel good about the AI server business. That 25% server and networking growth has to be better than 25%, right? And that would validate the AI server momentum that Dell has been talking about over the past quarter.
When you look at Dell, and I think we spoke to you a little while ago about the results that we got out of HP. And I know these are businesses that to a certain extent are kind of going in different directions. But is there sort of hope here that some of these legacy hardware companies have found new life in the AI story?
Yeah, so the way I think about the AI story is more of a feature rather than a premium device. What you will see is companies like Intel, AMD, and even Qualcomm, for that matter, include AI as part of their chip, and then the PC OEMs are just going to embed it in their device. You might get a slight premium, but let me give you a data point.
Okay.
Apple iPad Pro, right? That has AI-enabled features. You do not see a premium or for that AI feature. It was still a $12.99 device. And I suspect that's going to be the case for the PC market as well. Now, the one thing I will say, more so than AI, I do think that there is going to be a very strong Windows upgrade cycle coming into the second half of this year and even stronger in 2025. And I think that's one of the reasons why HP was up strong this today's trading day. And I wouldn't be surprised if Dell would be catching that tailwind as well.
Jin, can you talk to us a little bit about what these companies are doing with their cash? It was obviously a feature of the rest of the tech earnings season to talk about cash utilization, where they were going to deploy capital, as well as ultimately dividend and buyback announcements. And that's been notably missing in this segment. Are we talking about a big R&D cycle coming here? What are they doing with their capital?
Sure. So in terms of Dell, you have to keep in mind that these guys have been cash flow positive not too long ago, primarily because of their spinoff of VMware. They're going to be buying back or returning about 60-70% of that cash back to shareholders, and that they're going to be consistent, especially as revenues start to grow. As the AR storage starts to pick up steam, you should start seeing share buybacks as well as dividends coming from Dell.
All right, Jin Ho over at Bloomberg Intelligence, a closer look at Dell. Those shares all over the map. At last check here, down about 12 to 13%. Actually, one of the biggest decliners in the post-market trade. Some other big movers out there on the back of earnings as well, including Costco, Ulta, and Gap. Emily Raphael and Abigail Doolittle standing by with a closer look at those names.
Well, Romaine, we are looking at a decline here for Costco right now, down about 1%. Earnings just out a moment ago, so I'm still moving through them. But it seems to be that the weakness here is the fact that the comp came in at 6% versus the estimate of 5.51%, with the stock up more than 60% over the last 12 months. Just not enough. A similar deal for their earnings. They put up $3.78, a beat above the 370, but still not a huge beat. We'll also be looking for color on the membership fees. What makes this decline interesting, we've had so much color on consumers going toward discount brands, and that's one reason the stock has been up so much over the last year, as consumers trying to find those bargains, but simply not playing out in these numbers, and we'll, of course, be digging into them more. Now let's take a look at a big winner, because the Gap up sharply in the post-market. They put up a massive beat here. So the beat that they put up was 41 cents folks had been expecting a 13-cent, up 18%. Options really getting this right, expecting a 12% move up or down, clearly to the upside. The Old Navy comp coming in at 3% versus the comp at 2.5%. The gross margin, very positive, Romaine, 41.2% versus the expectation of 38.5%. We'll have more color on that as well. Romaine, you can see a really, really nice gain here. Emily, what are you taking a look at?
I'm looking at Ulta, and it was a mixed earnings report for the beauty retailer. That stock now higher in the post-market, but it had been falling. So we'll go over those mixed results. The first quarter was pretty much a beat all around. EPS beat coming in at $6.47 a share versus estimates of $6.29. Net sales beat just slightly at $2.73 billion versus estimates of $2.72. And that was also up 3.5% year over year. Comp sales beat. The forecast for 2025 is not as bright, though, and that did seem to be weighing on the stock, at least in the initial minutes after the earnings came out. The net sales forecast for the full year missed. The retailer sees 2025 net sales at $11.5 billion to $11.6 billion, just slightly less than what they had previously forecasted, $11.6 to $11.7 billion. They also cut their EPS guidance for 2025, and all of this coming after Ulta is already down 20% year to date. Those beauty retailers struggling against the broader market, which of course is in positive territory. Romaine.
All right, our thanks there to Emily Graffale and Abigail Doolittle. A nice roundup of some of their earnings that just crossed the wire. We also had Nordstrom a while ago, so let's stay in that retail space here. On the top line, the numbers are actually decent, roughly about 5% growth on net sales. But the issue here is profitability, Gina. Adjusted EBITDA down 34% year over year, and actually still came in below estimates. How was that possible?
I think it's really interesting to watch the differing results across retail. It does seem just quarter by quarter to have become this really unpredictable space. Yeah. And here we go again with Nordstrom just following up a really nice report out of Gap.
We've been talking all week about kind of the health of the consumer, and I feel like all these earnings reports you've gotten, it all seems so specific to each individual store. Maybe it's a reminder that we shouldn't just lump everything in one basket. But is there a takeaway here? I mean, do we walk out of this retail earnings season with more comfort, more confidence in the consumer, or less?
I think that's a great question. It's something we certainly have been contemplating as well, because if you look at the results, it does seem to be very company by company specific. And if you look at the consumer names, and I think this is an important point, in the S&P 500, the companies that we follow are a very narrow representation of how the consumer actually spends in this country. And so this is another case of markets are going to divert from the economy on occasion. You're going to see this really big difference in results relative to what you see in the economic numbers. And again, it really is company by company, industry by industry, because the issues of the restaurants industry, for example, are very different than the issues of the retail industry, are very different than the issues of the travel industry.
You track earnings performance pretty closely for the entire market here. Coming into this earnings season, did you anticipate these types of results out of the retailers, basically the consumer discretionary names?
Well, because they're such a small portion of the S&P 500, Romaine, we spend very little time actually thinking about the consumer space specifically. It has become really much more about what's happening in tech and communication services, the tech adjacent industries, as well as on the other end of the spectrum, what's happening with financials and industrials companies at large. So we spend less and less time on the consumer because they're a smaller and smaller share of the market cap of the index, which is important just to consider the idea that we have this giant economy perceived to be powered by consumers, yet that's not what's representative in the public markets. One thing that's very consistent, though, coming into this year, we knew that margins were going to be an issue for the consumer space. We knew there was going to be some struggles because inflation is still a problem. All
right, good point here. Of course, a lot of those retailers, including Nordstrom, on the back foot here in after-hours trading. Gap, the outlier here, up more than 10%. When we come back, we're going to have our top three segment where we focus in on the top three movers and shakers at the center of the day's biggest stories. That's next on The Close on Bloomberg. All right, time now for the top three. Every day at this time, we do that deep dive into the people at the center of today's top stories. And one of the biggest out there today is Jim Esposito, of course, the former head of banking and markets over at Goldman Sachs, now going to Citadel. He's going to be president, and this is actually a new position. They didn't actually have one. Of course, Peng Zhao has been chief executive officer over at Citadel. He will remain chief executive officer, but this newly created position for Esposito, he will report directly to Peng. Kind of interesting. I mean, he had announced his departure from Goldman earlier this year, so we knew he was leaving. We just didn't know where he was going to go.
Lots of top brass moving around in the financial industry, as always. I suppose that's no different than any other year, right?
Yeah,
But
absolutely.
nonetheless,
Here,
this is an interesting
yeah.
sort of Goldman to Citadel move.
Yeah.
I'm watching David Ellison, the film and TV producer, is sweetening his bid for Paramount. Bloomberg learns that Ellison's Skydance Media is reducing the amount it's willing to pay controlling investor Sherry Redstone and directing more money to the company's non-voting shareholders. Now, this is interesting because there are so many deals being done. This year has been great relative to 2023, where we had no IPOs. M&A activity was almost non-existent. We started to see some spin-offs last year, but now we're starting to get some action. Maybe it's a sign of risk tolerance.
And what I love about the Paramount deal is, like, this is like a deal that is going to get done. It's just a matter of at what price and what the sort of the contours of the terms are.
Absolutely.
I guess somebody's got to, make sure that, Sherry is happy, and and this thing will go away, whether it ends up with David Ellison or with some of the competing bids.
A little bit of nuance, but we think it's ultimately.
But it gives us something to talk about. Another person to talk about is not necessarily a huge name outside of the world of fashion, but this is a big deal here for Calvin Klein. Veronica Leone has been named a new designer here for the brand. Now, this is a brand that's really trying to sort of revive its cachet. I think, we're both old enough to remember when Calvin Klein really was like one of the hottest brands out there. It lost that cachet a while ago. There's a lot of hope that she could sort of really I guess, boost it back up.
Yeah, and potentially participation back in New York Fashion Week, which, we may not get to see, but we can be a part of.
Have you seen that show, The Bear?
Yes.
With the actor Jeremy Allen White. He's been featured in these new Calvin Klein underwear ads.
Wearing very little.
Yes, but it would kind of harken back to the ads from like way back, what was that, in the 80s and 90s, where they would have all these scantily clad, whether Kate Moss or Brooke Shields or all this. Yeah, so I guess everything old is new again. Just put a scantily clad person on the side of a bus depot, and maybe we'll all be buying Calvin Klein jeans again. All right, something to keep an eye on here as we refocus in on the economy. And we refocus in on Diane Swonk, KPMG's chief economist, going to be joining us in just a second to give us her view on the shape of the U.S. economy. This is Bloomberg. All right, welcome back. Romaine Bostick here alongside Gina Martin-Adams. We do want to get back to some of those quarterly earnings report from retailers. That includes Gap and that includes Nordstrom, as well as a few others. Mary Ross Gilbert, senior equity research analyst at Bloomberg Intelligence, joining us right now. Mary, you saw the numbers there on your screen here. Two stocks going in two different directions. One in Gap is a turnaround story. Nordstrom, I'm not sure what that story is. What jumped out at you most in the results that we just got?
Yeah, well, so actually, with Gap, I just think that we've been seeing a lot of things happening within the quarter with the brands, with Old Navy, a lot of really good marketing out there. Same with the Gap brand. We spoke about it before with the Gap X Jungle campaign featuring Tyla. And then, of course, you've got Nordstrom, but Nordstrom actually reported comp sales better than expected. So they actually had an increase in their full line stores. And we were sort of thinking that was possible because when we were walking the shops, doing our channel checks, we could see bags around the mall, Nordstrom bags around the mall. And then we had a feeling that with their positioning in the off-price business with Rack, that we would see good sales, and we did. Their comp sales lifted 7.9% above consensus 6% estimate. So that was also encouraging, but I think it's because they have a more premium consumer vis-a-vis the other off-price, where those consumers are a little more strapped by inflation. So I think that's sort of separating on Nordstrom. I think, and the profit they also beat there too. So, and they're very cryptic in their releases, so we don't know much until we get to the earnings call. But on the Gap side, I think that the execution is coming through in the numbers. Old Navy comps up 3%, Gap up 3%. Banana Republic, which had been negative, actually comped up 1%. Athleta up 5%. So all of the brands, are up. So I think that's very encouraging there.
Talk to us a little bit, if you would, Mary, about the Nordstrom story. You talked about there is a glimmer of hope there in the comp store sales and some of the shopping experience that you see real time. You see a little bit more activity. Yet the numbers were all pretty big misses relative to expectation. The stock price is down. Do you think that this is the turnaround quarter, or are we looking at more changes that need to be implemented across Nordstrom's platform in order to see a turnaround coming for 2025?
Yeah, so I think the big issue with Nordstrom, I think, has been mostly on the full line side and also on the profitability side generally. Their profits, their margins have lagged the sector for quite some time. And part of it could be on the off-price side. It's probably just not as efficient as it could be. But those are some of the things that they're working on. What they're really trying to do is drive a lot of growth there, opening up a lot of new stores. That's the big expansion story. On the full line side, trying to get that core business turned around. So I think they're making a little bit of strides, but I think it's going to take time. And with the Nordstrom family there, we'll have to see. It's just difficult.
So Mary, with the kind of the retail kind of consumer discretionary side of earnings season, more or less winding down right now here, what was the one standout this earnings cycle?
Wow. Well, one standout, you could say, it's Abercrombie, right? Because they just really killed it again with very, very strong double-digit comps against double-digit comps. So really resonating there. But Urban Outfitters Free People, also very strong. And same with Anthropologie, also an Urban Outfitters brand. So I think those two companies in particular really knocked it out of the park in terms of their results. And then I think off-price was sort of as expected, maybe not really hitting big numbers, but doing just fine.
Mary, Ross Gilbert over at Bloomberg Intelligence, a closer look at some of the earnings that we've gotten out of retailers here. And maybe that paints, or maybe it's a reflection of the backdrop overall of how the economy is performing. We did get an update on U.S. GDP numbers earlier this morning here, and we did see a bit of a cool down from the previous numbers that we have gotten. Still a relatively healthy economy. Diane Swonk over at KPMG, she is the chief economist. And, well, let's just pose that question to you, Diane. When you look at the numbers that we got, the official government data, and you look at some of the earnings that we've gotten, is that painting a picture of a resilient economy, a resilient consumer?
Well, we still have an economy that certainly is growing, and that's the good news. About 1.5% of the slowdown that we saw in the first quarter was due to a deterioration in trade, almost 1% there, and inventories were drained quite dramatically. Now that sets the stage for a bounce back in the second quarter, so that's good news. Consumer spending, really interesting. The decline in spending on goods, on everything from big ticket items that you needed to finance to non-durable goods, clothing, things like that, but an acceleration in spending on services. And that's one of the reasons we're seeing stickier inflation in the service sector, even as we're seeing goods prices not be as big of a problem as they were earlier in the pandemic. What I'm worried about going forward is that service sector inflation, some of it's structural, related to insurance and earlier climate events. We had $22 billion plus damages in climate events last year in 2023 alone. That was a record. And those kinds of things are pushing up insurance costs on everything from vehicles to homes. And that's not something the Fed can affect, which means you need bigger declines elsewhere.
Well, then I'm curious in how that feeds into consumer spending, because on some of the conference calls, at least the ones we got this morning, including from Foot Locker, including from Burlington, and a couple of others, even the companies that did well basically said, look, their consumer is being pinched. And I know KPMG just released this inaugural American Perspective survey, which is basically supposed to get the views of people. And we know how people feel about the economy plays a huge role in whether they spend money, or at least what they spend money on. What did that survey tell you, Diane?
Well, it's really interesting because you see what you're seeing in other surveys, that people feel better about their personal finances than they do about the overall economy. There are interesting differences, though, between CEOs and consumers. CEOs feel better about the overall economy, but not as good about their profits, which to me tells me you're getting that pushback from consumers, especially on goods prices. And we are seeing that out there. You're seeing many companies, many retailers saying that they're doing reductions in prices now. That's good because we want inflation to cool. The problem is, where is inflation sticking? In the service sector, where the more, that's half of the PCE index on the core is service sector inflation. So that's still a problem there. But I think that dichotomy you're seeing, the dissonance on the economy, personal finances versus their view of the overall economy. Also in the CEO survey, I think, the CEO side of it, you're seeing that feeling of fear that they're going to get pinched on their margins because higher interest rates for longer, now loans are resetting. And that's also a pinch. And they can't pass on those increases onto consumers on goods prices. The service sector is different, and so it's delineating between those two.
Diane, companies are telling us in our transcript analysis, at least S&P 500 companies anyway, are really focused on capital spending, and they're actually talking about improving capital spending prospects going across the next year. What are you seeing in capital spending components as it relates to GDP?
Well, right now, we actually saw an acceleration in capital spending in the first quarter in investment, and that was one of the bright spots in the GDP report. That's because we saw, again, the chip plants, and chip plants are being subsidized, and chip plants are still driving that in structures. But we also saw a big increase in intellectual property. That's coming from both the coming back online of the movie industry where writers were on strike and actors were on strike, but also it's in everything to do with Gen AI. We're starting to see that pick up from a very low base, but big numbers off of a low base and big increases off of a low base in kind of a U-shaped sort of investment strategy with the largest firms leaning into it, and then the smallest startups leaning into it. But what's important about that is it's also a very big stress on our energy infrastructure and forcing Silicon Valley to look very closely at finding more sustainable sources of energy, and things don't cost as much for them, looking more into renewables. And I think that's going to be a big investment place we're going to see this year as well.
Diane, I have to interrupt you here. Some breaking news. We're now learning that the jury in Donald Trump's trial here in New York has reached a verdict. We do not have that verdict just yet here. But after basically 2 days of deliberations, the jury has made a decision in that hush money case involving former President Donald Trump. Again, we do not know the verdict yet. We are still waiting for that to be read. But of course, we will have a readout of that and instant analysis as soon as we get it right here on Bloomberg. Once again, the New York jury that is deciding Donald Trump's fate in that hush money trial has reached a verdict. We do want to go back to Diane Swonk, chief economist over at KPMG. Our discussion here about the state of the economy and the state of the consumer. Diane, I do want to ask you here, we focus so much about the health of this economy on what is affecting the consumer itself, but I am curious about what's affecting the companies. They're still dealing with inflation, particularly on the wage side. They're still dealing with inflation on the supply side. Is there any concern here that some of those issues still have to work their way through the system?
Yes, and in fact, we've actually done some analysis looking at both quit rates when we had the hiring frenzy in 2021 and 2022 and the surge in wages.
All right. I'm sorry. We lost. Oh, keep going, Diane. My apologies.
That's okay. But what we saw is a breakdown. Wages increased more rapidly than the quit rate suggested, and they've not come off as rapidly as the quit rate suggested. So we're getting some stickiness in wages as well. And that's very hard because we're seeing low wage workers, their increases are slowing, some of them below the pace of inflation, but still moving up much more rapidly than they did pre-pandemic, putting upward pressure on service sector costs. At the same time, high wage consumers have had much higher wage gains and tens of thousands of dollars more over the course of the pandemic, and they're spending on the discretionary side, keeping services afloat, which is putting the Fed in this very hard position where many consumers are feeling the pressure of inflation while we're still putting upward pressure on inflation by high-income consumers spending on that discretionary dollar and on services.
All right, Diane, I'm going to have to leave it there. Always wonderful to talk to you. Diane Swonk, the chief economist over at KPMG. A closer look at the state of the U.S. economy, and a reminder, we do get that PCE data tomorrow morning, 8:30 a.m. Washington time. Now, we do need to go back, of course, to a big breaking story, and that involves the former president of the United States, Donald Trump. That hush money trial here in New York, that jury, after 2 days of deliberations, we have learned, has now reached a verdict. Kailey Leinz, the co-host of Balance of Power, standing by right now. And Kailey, we should point out we do not know the verdict, but it has been reached in pretty short order.
Yeah, Romaine, we learned this when the jury sent a note to the court at 4:20 p.m. requesting an additional 30 minutes to fill out the form that is actually required, saying that indeed they had reached a verdict. We do not know yet if they have reached unanimous consensus on all 34 counts of falsifying business records, a Class E felony that Donald Trump has been charged with here. But we do know that they have reached a verdict to at least have consensus on some of them. Remember, it requires all 12 members of this body, a jury, of former President Donald Trump's peers, American citizens, to agree in order for him to either be acquitted or convicted of these charges. If there is not unanimous consent, then we could end up with a hung jury, at least on some of the charges. Keeping in mind here that of these 34 Class E felony counts, with each one comes a maximum sentence of 4 years in prison. Once this verdict is read out, we will not know immediately from the judge what Donald Trump's sentence would be if he is convicted of any of these charges. That sentencing hearing would come separately. But now we are really reaching the moment of truth here as we await a actual verdict from this jury in the hush money case, Romaine.
It is, of course, a stunning time that we live in right now. This, of course, was the first criminal trial of a former U.S. president. And ostensibly, Kailey, this was really not about the worst allegations against the former president. In fact, a lot of people looked at this case and they said, look, does this really matter? We know what the charges are. If for some reason he is convicted, we also know that the penalty for that is probably not all that severe.
Yeah, it's worth pointing out, Romaine, that most legal experts we speak with do not actually think that Donald Trump would spend time behind bars in this case, though jail time certainly is an option, considering this is a former president who is entitled to Secret Service protection. Even just the logistics would make time in prison incredibly complicated. And many had said that this was the weakest or least serious case that had been brought by the district attorney, Alvin Bragg, considering that this really is about, in many aspects, payments to a porn star. The thing the prosecution has been arguing, though, is that this was done with the intent to sway the result of the 2016 election. But essentially, in the days before the election, Donald Trump, according to the allegations of prosecutors, wanted to make sure that this story didn't get out and hurt his chances of winning, which, of course, he ultimately did. So potentially the kind of salacious nature of this could be something that still could impact him electorally as he seeks another go at the presidency. He is, after all, the presumptive Republican nominee, although recent polling, including one just out today from PBS and Marist and NPR, finds that about 2/3 of voters say that a conviction would not actually change their mind on Donald Trump. The more serious cases, including the one brought here in Washington related to election subversion, a separate 2020 election related case, a state case down in Georgia, and the state in or the federal case in Florida related to classified documents. All of these at this time, Romaine, are not going forward to trial. This is the only one that likely will do so before the election.
Well, sticking with this trial, it is interesting that you cite that poll here, that this, for a lot of folks, really isn't going to sway them no matter what the verdict is. I do want to ask you, though, about the political implications, particularly of all the hay that was made of that press conference that Robert De Niro gave the other day. The idea here that the Biden administration, maybe ill-advised, has now waded into this, kind of making it a political issue instead of just a legal issue. Is this going to be a political issue, Kailey?
Absolutely, Romaine. And Donald Trump has consistently been trying to make it one. We have heard him each and every day outside the courthouse for the duration of this trial, talking about how he views this as all really a plot by Biden, even though that is not factually accurate. He says that this is Biden weaponizing the justice system against him. And he has shown an incredible ability to fundraise off of these very legal challenges that could ultimately lead him to be a convicted felon. Again, knowing we do not know the verdict here, but he has used this as a way to galvanize support, fundraise, and earn a lot of free media. Considering that he is running an active presidential campaign. He could continue to do so even if convicted. A lot of people have talked about how this could be a win-win for Trump here. Either a win if you're acquitted because you don't face prison time, but also potentially a win even if you're convicted because it just refuels the belief among the base of supporters that Donald Trump is being treated unfairly here. We should point out, too, I mean, we had that big press conference, but there have been several days during this trial where we've seen some pretty prominent members in the political community, members of Congress, including the Speaker of the House, sort of make their way down there, I presume, as a show of support for the former president. Yeah, in part, Romaine, that was because Donald Trump, throughout the duration of this trial, has been under a gag order. So he was limited by the judge in what he could say about potential witnesses, members of the jury, even members of the judge's own family. Those surrogates who made their way up to New York in many ways were doing that for him, being able to say things that Donald Trump could not himself without being held in contempt of court, which he was in multiple instances earlier on in this trial, fined $1,000 per instance. So those supporters were not only there in a show of support, highlighting the very political nature of this, but also being able to do some of what Donald Trump could not, and including in those not just sitting members of Congress like the Speaker of the House, but a number of potential vice presidential contenders, including North Dakota Governor Doug Burgum, Vivek Ramaswamy was there, Congressman Byron Donalds was there. All of those, we understand, could be on the short list for VP, which just serves to remind us, Romaine, the individual we are talking about here that we are about to find out is either acquitted or convicted on a number of felony charges is still in the running to be the president of the United States, and in fact is leading in a large number of polls.
Yeah, strange times we live in. Kailey, you got a busy night ahead of you. Kailey Leinz, co-host of Bloomberg's Balance of Power. Sit tight. We do want to go down to the courthouse in Manhattan, in New York City, where the host of our Big Take podcast, David Gura, is standing by. And David, the news just crossed a little while ago. A verdict has been reached. What do we know?
Well, a bit of a surprise here. It's now past 4:30. That was the time at which the jury was supposed to disperse at the end of the day. We saw them called back into the courtroom. The judge, before that happened, gave an indication he was going to dismiss them. Then all of a sudden there was this note from the jury that, in fact, they had reached a verdict. And what they've asked for, Romaine, is about 30 minutes of time to fill out the requisite forms detailing what their verdict of all these counts is. So a bit of electricity floating through this area here in Lower Manhattan as we await that verdict. You can hear a helicopter overhead now, and people sort of poised to find out what this verdict's going to be.
David, give us a sense here as what it looks like on the ground. I know there had been some concern here about security measures that might be needed around the announcement of this verdict here. Are there supporters or protesters gathered around?
Just about a block from where I'm standing is a small park in which there are two sections, one for supporters of the president, one for those who are protesting him and yelling out, lock him up. A much smaller group than on the side supporting him. Still, though, we're talking about just dozens of people. It has swelled a little bit here as the day has gone on. But I will say, Romaine, the police presence is sizable. They've kept it largely under control. There have been some small altercations among both sides, but nothing overly dramatic and nothing that I would describe as being tense. As you can see behind me, traffic continues to flow. Bikers are going by me in the bike lane here as well. So by no means has this part of New York been locked down. We'll see what happens here after this verdict is announced. But by no means is the crowd large or uncontrollable. And I will say it's still dwarfed by the amount of reporters and cameramen and producers who are here from media outlets all over the world awaiting this decision.
This is, we were just talking with Kailey Leinz, David, and this idea here that this is unprecedented by so many measures. The first criminal trial of a former president, not to mention just all the optics around it right here in what is effectively the financial capital and the media capital of the world here. I'm actually a little surprised that we didn't see a little bit more of a dog and pony show on this day, even though we kind of knew this verdict might come today or this week.
Yeah, it's a great point, and the symbolism is very present, as you say. But a lot of what happens behind closed doors. Of course, the jury's deliberations happen behind closed doors, and we have no vantage into what those discussions were like. But even when the former president comes out and speaks, he's doing that within the lobby of the courthouse behind me. He's not coming out here to the park or to the reporters who are gathered out here. So it's done to a rather small crowd, a pool of reporters who are getting those remarks. And in fact, when he comes and goes, a lot of that is obscured by trucks and SUVs that are designed to kind of keep that hidden from people who are watching. So, you know, there's the symbolism, fraught with symbolism, but there's an effort here to keep it contained and keep it in a fashion that is both safe and civil, I think.
How close can you get as a reporter? I mean, how close are they allowing the media to get to the courthouse and I guess, to be more blunt about it, to the former president?
Yeah, I mean, the courthouse is right behind me, so just several hundred feet away, and we have colleagues at Bloomberg who are in the courtroom, in the overflow room, so we have colleagues who are inside the building itself and who have eyes on the former president and have been watching all of these proceedings unfold in person. Those folks are lining up earlier, much earlier than I woke up to get in there, and those seats are limited, of course, and there are a few members of the general public who have got in as well. But again, he is whisked in here in the morning. The motorcade comes through, he goes inside. That's largely not visible to the public, not visible to cameras and reporters. I myself have not set eyes on him yet. Again, a lot of that happening behind kind of this obscurance of vans and trucks and SUVs remain.
All right, David Gura outside the courthouse in Lower Manhattan, awaiting a readout of the verdict in Donald Trump's hush money trial. We have learned, of course, the jury has reached a verdict after 2 days of deliberations. 12 men and women now hold the fate of the former president in their hand. Greg Farrell joining us right now, Bloomberg legal editor here at Bloomberg News. This is kind of a good time to kind of refresh everyone about the charges themselves, because it gets a little complicated. We keep calling it a hush money trial, but it's very complicated because this isn't really just about the money itself, but about kind of how it was all reported.
Yes. In fact, much was made of Stormy Daniels' appearance and Michael Cohen's appearance and sex with a porn star. But in fact, it's a boring books and records case. And what the prosecution had to do was establish the facts of the whatever liaison the president had with Stormy Daniels a long time ago, the payment of money for that, and then make it kind of a not tortured but difficult legal argument that by booking these transactions, the payoff so that she wouldn't go public before the election, this violated the New York law against books and records, against inaccurate books and records. So there's 34 charges, which sounds daunting, but basically it's one alleged crime. That is that they're covering up the payment, and it is, in fact, could be interpreted as a contribution to a federal election.
So remind me, let's talk about the jury for a second. They weren't sequestered, right?
No, they were going home at night.
So they were going home at night. There's been a lot of discussion about Donald Trump's public tactics. I won't call them legal tactics. And there's been a lot of concern that once we do get a verdict here, what the basis for appeal would be. Do you think, based on what you saw in this trial, there would be a basis on that based on what we know about the jury and the way that they deliberate, or the way that they handle this case?
I think there's definitely an appeal here. I'm not sure if there's any problem with the jury. I think it's just kind of a stretch. The case itself is, in order to get a felony, take a books and records violation, which is a misdemeanor by itself, and elevate it to a felony, which is what the goal was for the DA's office, it has to be covering up the books and records to disguise another crime. And the crime they've identified is basically defrauding the, not the U.S. government, but defrauding the public, violating campaign finance laws. It's something Michael Cohen pleaded to in federal court a few years ago. And Trump was not charged by federal prosecutors with that. So I think he's got definitely grounds for appeal. We're acting as though it's, a verdict is going to be this way and not that.
Yeah, we have no idea what it's going to be.
We can guess, and the fact that it's occurred this quickly, after all this, voluminous amount of evidence suggests maybe something, but we don't know.
Talk about what the judge now has to do. There was a great story on the Bloomberg terminal today about the instructions that the jury was given prior to going in to deliberate. We've had a couple stories about some of the requests that they've made. This is a judge that obviously has to be very tactful with this in a high-profile case involving a former president here. What is the process right now?
So if the verdict is guilty, in a normal state case, then the defendant, gets bound to prison, and even though there's an appeal, you don't get to, delay it or anything like that. That will not be the case here. This now, the judge becomes center stage in what he decides here, because we're really in unknown territory. Or if the verdict is one way, then we'll be in unknown territory. So almost certainly, if there's a guilty plea, there will be no heading off to Rikers Island or anything like that.
What did you make of his defense, of the Donald Trump legal team's defense, which was short and pretty concise here?
Yes.
Should they have done more? I mean, just based on your own sort of legal assessment.
Well, I think the goal was, and there's a strategy to both sides, and the DA's office did not want to build an entire case around Michael Cohen, because Michael Cohen is well known. He's well known for having pled guilty to other crimes and having lied in the past. So
they brought that up to him on the cross,
absolutely,
right?
And they brought it up indirect, because a good prosecutor will not leave that to a defense lawyer to create an aha moment, but to try to get that out there. That's a common practice in court.
And we knew going into it. I mean, it's been public knowledge that he's had a somewhat strained relationship with the truth with regards to Michael Cohen. But they still put him on the stand. They must have thought he was credible enough.
Well, they built it up with enough evidence. That's why they had Stormy Daniels there. That's why they had the accounting people from the Trump organization. They spent a lot of time in the last few weeks putting all these building blocks in place. And then Michael Cohen. Trump's defense was to try to destroy Michael Cohen's credibility. And over a couple of days, they drew some blood. We'll see whether or not they destroy. It could be if they got the jurors to disbelieve Michael Cohen, then maybe this verdict's going to be, one way instead of the other.
But they did not put Donald Trump himself on the stand.
No, and that is, that's fair practice. That's good practice for most defense lawyers. Do not want to put the client on the stand. And Trump, even if this turns out that he is innocent of this, he's not a good. Any prosecutor who can't get him to contradict himself in a short period of time is not like a good prosecutor. One of his own lawyers told me that. It's just the way he is.